Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's Hot Sheet, I will discuss the latest housing inventory update, debt ceiling correction, Zillow's April housing report, and the highest paid occupation in construction. Today is Monday, May 15th, 2023. I am Byron Lazine, and the Hot Sheet starts now. Okay, we're going to wait till the very end to share those earnings in the construction field numbers with you. If you've got a son or a daughter or somebody who is, close to you, a family friend who's about to graduate high school and accumulate a bunch of college debt without a clear path to what they're utilizing that debt, debt is supposed to be leverage. What are they using that leverage for? Make sure you stick around for the last segment. Share this video with them. Hit the thumbs up, and let's get right into our weekly inventory update via HousingWire, just released late last night from Logan Mohtashami. Total active listings grew 662 for the week. So we had an increase off of last week on listing inventory, okay? But it remains ultimately very stubborn. The new listing data is still trending at all-time lows, okay? So let's dig into what this looks like. We saw a decrease last week on housing inventory after seeing 2 weeks in a row of an increase. This is troubling in May because this is when you typically will see inventory rise as we are in the heart of the spring selling season. This is when the majority of the buyers are out home shopping. The smart sellers know this, they understand this, and if they want to get top dollar for their sale in any particular year, they usually want to capitalize on this particular moment, the spring selling season. We're not seeing sellers do that. Leads me to believe that quarter four is going to be even worse than last quarter four. Because if sellers aren't willing to get off the fence now, when all the buyers are aggressively shopping for homes, and history tells us the most buyers are shopping for homes right now, then they're certainly not going to go list it at the end of the year. If they're not getting off that fence now, when will they? So we see that inventory here. Let me fix that. We see that inventory is up, but it's only 600 homes. That's just not enough for what we want to see here at this point in the year. What is going on here? Let me unplug my iPad and plug it back in. See if we can get it to correct itself here. I did test it before the show, but of course, Monday morning. Here we go. All right. Now you can see that if you're on YouTube. Weekly inventory change from May 5th to May 12th. The inventory rose. This was 419,420. That's that 622. The same week last year, we rose from 300,000 to 312. Sounds like we have a lot of inventory, but we're still near an all-time low, and we don't have the new listings coming on. So some of this 100,000 difference from what I see on MLSs is inventory that's not meeting today's demand. Let me know if you see the same thing in your MLS, if you're an agent or someone with access to the MLS, maybe an appraiser, where the inventory that's sitting around isn't meeting the current demand that's out there. The inventory bottom for last year was 240,000. The peak so far this year has been 472,000. We're well off of that peak. For a little context, 2015 active listings were 1.1 million. You can see here on the chart below from Altos Research, shows us where active listings, how they record them at this 420,000 numbers, well below 2020 and any of the years preceding that. Okay, they calculate active listings the way I look at them, which would be listings available to buy, not ones that are pending under contract. Here you can see new listings isn't even at the pace of 2021 and 2022. So we are at a near all-time low on new listing data, and we're trending towards this year being the actual all-time low for lowest new listings onto the market. Now, here's how NAR calculates active listings. A normal market, you can see on the bottom chart, the normal market would be between 2 and 2.5 million. Their active listings include pending sales, deals in escrow. Okay, we are still under 1 million, and we've been under 1 million for quite some time here, really going into Q3 of last year, or beginning of Q4 anyways, of last year. We've been under 1 million active listings as how NAR calculates them, which is including all the pendings and the escrows. Okay, so inventory is still taking an incredible hit right now. Let me know if you're seeing any signs in your local market of inventory coming back on. I'd be curious to see which market that is. Certainly in the lower price points, we're just not seeing enough new listings come onto the market. You can see here new listing data for this week in May over the past 3 years. This year was 62,000 compared to 73,000 in 22 and 71,000 in 21. If we go back to 2015, 2016, and 17, we're talking 98,000, 82,000, and 90,000 in those respective years. We're nowhere near new listing inventory numbers that we've seen in the past, and it's really because people are sitting on 2 and 3% interest rates. The interest rate hasn't come down far enough for them to decide to make that move, even if they want to make a move. The interest rate's not close enough to their spread to entice them to make a move, and with inventory being low, it's another concern. If I sell, what the heck am I going to buy out there? I'm hearing stories of 20, 30, 40 offers in affordable price ranges. So if they're an affordable home shopper, it makes it that much more difficult. Okay, if you were on the stream for Friday, I made a correction in the comments below, and I have to make another statement on the correction. So on Friday, I covered the Zillow report that if we don't raise the debt ceiling, if the U.S. defaults on their debt, that interest rates would go over 8%. That was a Zillow prediction. But then I misspoke and said that home prices would go down over 20%. What Zillow was saying was sales, total transactions would go from a seasonally adjusted rate of 4.4 million, where we're at right now, down to like 3.4, 3.5 million seasonally adjusted. It was in the low threes. Okay, so that was the 20% spread, not prices. Now I have an update on what they're saying, as well as what Moody's Analytics is saying. Let me go to the Zillow chart first. Zillow here, and this is in line with my correction. This is where they say home values will dip if the U.S. defaults on their debt. Home values would dip about 1%. So sales would drop 23%. Home values would drop 1%. Okay. But we get it right here on the hot sheet. I know Fox News or CNN would never do this, come on and correct something, but we do that here on the hot sheet. Home values would dip about 1% and end up about 5% lower at the end of 2024 in the debt default scenario in the baseline forecast. Okay, so this is down below. All the charts, all the sources that we use today and every day are down below on the daily download link. You just click it once, you get it every single hot sheet. Okay, so there you go. I find it hard to believe, by the way, that if the U.S. defaults on their debt, that home values are going to drop 1%. Because again, they're predicting that interest rates would go up over 8%. And we saw in many areas that when the interest rate hit 7.37 at the end of last year, that places like Austin and the West Coast and many other cities saw, double-digit home price declines. We get up over 8%. That's unseen territory for the country. I think we would actually see a decline greater than 1%. Just my opinion. I'm just skeptical on that. Okay. The unemployment rate, by the way, would jump to 8.3% by October 2023, according to Zillow, if the U.S. defaults on their debt. Mortgage rates would hit 8.4% by September, but U.S. home prices would only decline 1%. I just, maybe because they're just going to say there's just no transactions happening at all because of that drop in transactions, 23% drop in transactions, that it would create such a Cold War stalemate type of situation that values would just stay stuck and frozen in time. But if unemployment jumps to 8.3%, anytime that happens, you see values go down because people got to make moves to survive. So couldn't see that happening. All right. So now what does Moody's think about this debt ceiling? So Moody's analytic chief economist Mark Zandi told senators earlier this month that the U.S. Treasury could run out of cash as early as June. If Congress doesn't act and U.S. were to default, it would have these broad economic consequences. Okay, this is a piece from Lance Lambert in Fortune. So the unlikely scenario, and again, this is an unlikely scenario, just touching on it again today because I wanted to make that correction for Friday, but I want to go a little bit deeper since we're taking the time to touch on it. All right. They would go back above 7%, 30-year fixed, Zandi says. So he's not in the 8% camp, but certainly back above 7% if a default looked likely. So leading up, and this is similar to Jamie Dimon's comments, CEO of JP Morgan, where he said in the weeks as we get closer, if they wait till the deadline, we're going to see turmoil in the markets. We're going to see some chaos happening. So you could see a mortgage rate that starts to go up if we get closer to this deadline. Another big jump in mortgage rates would be a gut punch for many home buyers and sellers, obviously. Home prices were already down 3% from 2020 peak. They would fall 8.6 peak to trough during this cycle if this were to happen, according to Zandi. Of course, we've seen in recent months that home prices have in fact started to go up month over month after seven straight months of decline. National home prices rose in February. They also rose in March. This is according to Case-Shiller, this chart here. But we've also seen many reports where they rose in March as well in April. And we think that Case-Shiller, when Case-Shiller's lagging data comes out, that it will reflect that as well. Okay, so Moody's in line with Zillow, that if we were to default, we're going to see some turmoil in both mortgage rates and the housing market overall, and certainly the job market. Okay, speaking of Zillow, their April report shows a strong seller's market, of course, with rising demand and low inventory. This is on nowbam.com. This is Zillow's April report. Okay, I just want to go through some of the data here. Zillow's home value index for April shows U.S. homes at 339,336. Home values climbed 1% from March to April, the biggest jump since June 2022. It's normal for this time of year, and we're in a normal situation with prices going up right now in spring, but not with obviously the inventory going up. The 22 markets with year-over-year declines would include Austin, San Francisco, San Jose, Seattle, and Sacramento. Austin over at a 10%. And then all of the 5 above markets, however, recorded monthly gains: San Francisco, San Jose, and Seattle. We did cover this on a recent stream where we looked at each and individual location. You can go back and check that one out. New pending listings, okay, we're down 21.2% year over year, but 2023 is sitting above 2018 for pending listings. Interestingly enough, when you look back at the last 5 years, at this time of compared to 2018, which was a higher mortgage rate time period in the last 5 years, we are sitting above that for pending listings. And then you can see here, new listing data is reflective of that of Altos, where we are at an all-time low for new listings. You do see the 2020 spike down for this particular month, but it spiked right back up. There's no indication that we're going to catch up to that 2020 spike up. As you can see, we are riding extremely flat, and with the numbers from last week coming in at plus 622 new listings for active listings, rather, for a population of 330 million. Find it hard to believe that we're going to get there. The Zillow Data, Zillow Research Hub is starting to rival that of Redfin for me. I put this one down in the daily download below. You got really good data. So if you're in housing, you should be looking at this along with Redfin. This is a great breakdown. I put this slide into the daily download, shows the 339,000 for April for Zillow Home Value Index. It's up 1% month over month, 1.5% year over year. The median list price is 394,000, up almost 4% month over month, 4% year over year. Median sale price coming in at 340,000, which is up 3% month over month, down 1.45% year over year. Percent of sales above list price, 30%. That's up 5.5% month over month. So we're in a time period right now where that is the trend. Probably will last another 6 weeks where you get those types of numbers sold above list price. Won't last all year. Want to be clear on that. Homes sold above list price, again, 30%, would be lower than 2021 and 2022, where we saw 41% and 53%. Okay, so let's be clear. This is not 2021 and 2022 sellers market, but it is an abnormally strong sellers market due to the inventory. Okay. March is down below on the bottom there. If you want to do comparison to March home sales, 266,000 versus 323,000 pre-pandemic. It's almost a 30% year over year decline. Okay. I love this hub from Zillow. They're improving it seemingly every single day. If you just kind of scroll down there, I didn't put this one in the daily download, but you can take a look. Top reasons for homeowner hesitation: concerned about finding or affording a new home, that's 26%. Current life uncertainty, 24%. 10 days, median days to pending of listings that went under contract. And that is basically back to the all-time low of 2022. So market is it's kind of bifurcated. It's all over the place. It's just like different cities, different metrics. The numbers are all over the place. You got to dig into your local market, like we've been talking about on this stream a whole bunch. If you know anybody going into college, you also got to dig into what their goals are. Right now, we're into that high school graduation season. I have my oldest daughter rather is graduating from kindergarten at the end of this week, and there's going to be high school graduations to follow. A lot of high school graduates are being told to go into college, to go take out some debt and get a 4-year degree. Well, NAHB, National Association of Home Builders, just came out with a report, the highest paid occupations in construction for 2022. And to me, these are far and above a lot of the earnings you can get by going out and taking $20,000, $30,000, $40,000 a year in college debt. Let's take a look at what they are, and maybe you could help somebody get into construction, which is, by the way, construction, you've heard me rant on this before. It can't be disrupted by AI. Somebody's got to go in and do the HVAC. Somebody's got to do the plumbing. Somebody's got to do the electrical. These licenses are hard to get, but they're gold. You can build great businesses in this country today, and there's less competition. People aren't willing to do it. Everybody's going into general studies when they should be looking at how can I get one of these specialized jobs. Okay. So if we take a look at some of these jobs here, highest paid occupations in construction. Okay. Here we go. We've got chief executives and lawyers. I'm just going to cross those out. Those are going to be, longer. It's going to take you some time to get those. All right. But here, let's take a look at some jobs you can get without a degree. A sales manager in construction. Certainly don't need a college degree for that. And we're talking about the top 27% make $167,000 and the median is $122,000. Okay, purchasing managers don't need a degree. The median is $117,000. Fundraising managers, $117,000 median. Okay, training and development managers, that's another one. 111,000. Marketing managers for construction, I know plenty of them without a degree, 110,000. Okay. So there's a list of some of the highest paid construction jobs in 2022. You don't need a college degree for. You get into the field, by the way, of construction, and just automatically you're making more money than you would at a median wage in this country with a general studies degree. Okay. According to the latest Bureau of Labor Statistics, Occupational Employment and Wage stats, and analysis by National Association of Home Builders, half of payroll workers in construction earn more than $54,540. And the top quartile, 25%, make at least $77,000. In comparison, the U.S. median wage is $46,310, while the top 25% makes at least $73,000. So in both categories, payroll workers in construction are making more than median wage, and the top 25% in median wage. Okay. Among construction trades, elevator installers and repairers top the median wage list, while half of them are earning more than $100,000 a year, and top the 25% making at least $123,000. Rock splitters are next on the list. Okay, followed by first line supervisors of construction trades. You can get into the construction trade and become a first line supervisor without any college degree. In general, construction trades that require more years of formal education, specialized training, or license tend to offer higher annual wages. Now, you do have education. I'm not against education. Okay, I'm against this generalized study, this liberal arts, this business, business administration degree that isn't applicable in entrepreneur land. Okay, median wages of construction and building inspectors are 64,000. The wages of top quartile on the pay scale exceed 85,000. Plumbers, this is where you would need education. They earn more than 60,000, with the top quartile making over 79,000. Electrician wages are similarly high. You've got to go into an apprenticeship. You need education. You get paid a lot of times when you do that, so you're not accumulating debt, and then you come out earning more than the 45, 50,000 that a lot of these college education degrees are earning. So I think it's an interesting study to share. We've got the link down below in the daily download, the source from NAHB, as well as the chart. Share with somebody who's thinking about their next step. This is graduation season. We know that if we're going to solve the inventory crisis in housing, we're going to need people in the trades, or you're going to keep hearing the same thing. Like, if I could find the work, I could take on more jobs. If I could get skilled, qualified people, then we could get more inventory onto the market. Then we could get more jobs done. Then we could get more renovations done without having to just jack up the price. If a contractor has one crew and they've got 10 opportunities for jobs, well, they can only be on one job at a time. What do you think happens when they give out quotes? They say, well, I'm just going to keep raising my prices until somebody says no, because I really can't take on the work. It's supply and demand, right? They have limited supply, the workforce. There's huge demand. I'm just going to inflate my prices until enough people say no. So a few of them say yes, I'm making a killing. Whereas if I've got enough of a workforce, I could actually lower my prices and be more in the volume game. But construction trades are, outside of Pulte and, KB Homes and some of the big ones, they're not in the volume game because they can't get the labor to help them out. Let's see if we've got any help here on the 10-year where we're at today. We are up just a slight tick. We're up to 3.498 on the 10-year. Anytime we get to 3.3, 3.4, we really start to see a 30-year fixed mortgage rate that drops down below 6.5. Last week, we ended the week at 6.55 after just touching under 6.5 on Thursday at 6.49. We'll potentially see that maybe tick back up, but we've been bouncing for quite some time between 6.5 and 6.6. You can get up as high as 6.7, according to Mortgage News Daily's daily survey on the 30-year fixed. So probably be similar to that as we close out today. And before you close out your day today, make sure you subscribe to this channel, because at 7 p.m. here on the live tab, we're going to be doing a debate with Barstool Sports. It's myself versus the producer of the Kirk Minahan show. It's going to be live at 7 right here on the channel in the live tab. So make sure you hit the notification on that thumbnail. It's Bam versus Barstool. It's a real estate debate. This Barstool producer wanted to run his mouth that he knows everything about housing and real estate. I'm asking all of you to come support me tonight on the live feed at 7 p.m. when I debate Barstool Sports on real estate. We know real estate better than anybody, especially those of us that are here every morning on the hot sheet. So please join me for that. Also at 11 a.m., we have a new Overask podcast that will be premiering here on the channel. And if you haven't done it already, make sure you subscribe down below to BAMX. If you sign up for the annual deal, it's basically a cup of coffee a month. It's your real estate marketplace for business, marketing, and social media. We've got BAMX member courses, BAMX member live streams, as well as creator courses where every BAMX member gets significant discounts to those. Make sure you subscribe over to BAMX. Link below. Debate tonight, 7 p.m. Bam versus Barstool. Thank you guys for tuning in to this hot sheet. And until tomorrow, post debate, have a great Monday and toodaloo.